Welcome everybody to our session on cross-border trusts and estates, Tax 101. We've got over 200 people registered for today's webinar, and hopefully they'll be joining us quickly as we get going. If you had any issues with accessing it, I'm guessing you're on here, so that's not a problem, but we did send out a second email to help people access today's session. My name's Warren Dueck, and I'm part with Andersen LLP in Vancouver, though I look like I'm somewhere out of the world. My partner, Steve Flynn, is also joining us here. And we have a guest speaker today, and that's Marsha Dungog. Marsha is a lawyer with Withersworldwide in San Francisco. And Marsha has extensive experience in Canada and actually used to reside in Canada. We're disappointed Marsha's no longer here with us, but Marsha's particularly a special guest speaker because she was instrumental in the issuance of IRS Revenue Procedure 2020-17. Now, that number may not mean a lot to you, but it is important, and she's going to talk briefly about that today. So I won't steal any of her thunder on that.
Thanks, Warren. Nice to join you guys formally on our real webcast. I feel like working with you before I came to Andersen, and then after I left Andersen, we're all part of the Andersen family. Really looking forward to this webcast.
We're glad to have you on board here. Now, we want to encourage you, if you have questions, hit the Q&A button on your screen there, and you can write questions. We're going to spend some time after the session answering those questions. There's also an online survey that we'll send you at the close of the webinar, and please fill that out. We appreciate your comments, suggestions, and criticisms, so feel free to do that. Today's subject, cross-border trusts and estates, we're going to focus mostly on kind of Canada-U.S. type of issues. This is a huge subject area, and it's significant and it's complex. Anybody who's in the financial professional service area have seen this area expand significantly. Now, Canada and U.S. tax have a lot of similarities. But what I'll warn you about, it's really the differences that count. So we're going to try and highlight some of those things, and it's that contrast. And as Canadians, we get really sensitive when and most of our listeners here are Canadians, though we do have people from the U.S. as well. Canadians get really sensitive when they feel like that Americans aren't paying attention to Canadian law. But we make, as Canadians, we make the same mistake thinking, oh, because we do this in Canada, they must do it in the U.S. This is always a critical subject here. So we'll move ahead on this. We've got a number of topics we're going to cover today. This is a huge topic. We could spend a whole day talking about this topic and not exhaust it. But we're going to talk about basic trust taxation, some key U.S. concepts. Steve's going to highlight a couple of very unique situations. We'll talk briefly about U.S. estate and gift tax, and then lastly about filing requirements. So if you're ready to go, we'll start talking about trusts. And firstly, what is a trust? Now, it's a little bit odd that here I, as an accountant, I'm a CPA in both Canada and the U.S., and I'm defining what a trust is, because that's really a legal concept, not so much a tax concept. But it's a fiduciary relationship where a trustor or grantor gives property to a trustee to care for it, to hold that property for a beneficiary. Now, that's a pretty broad definition. It's not going to knock anybody out of the park here. But what I want to bring your attention to is that just because something is a trust for Canadian tax purposes or under Canadian law does not necessarily mean it is a trust for U.S. purposes. One of the leading cases here is something called the Mexican Land Trust case. Those who deal in cross-border issues may be familiar with this, something called a fideicomiso. I don't speak a lot of Spanish, and I'm not even sure what that means, but that's what the case was about. The IRS concluded that even though it was a trust under Mexican law, it was not a trust for U.S. tax purposes. So just because someone calls something a trust doesn't mean it's a trust for both Canadian and U.S. tax purposes. Now, the tax residency issue becomes a critical consideration here. And Steve is going to talk more about this, but I'll kind of outline this subject. U.S. tax law gives a definition of tax residency. The code does. And it says basically this: if a trust is subject to primary supervision by a U.S. court and U.S. persons make all substantial decisions, it must be a resident of the United States. And Canada, on the other hand, has extensively broadened its definition of residency for trusts. And for factual purposes, it's where essentially central management and control are in Canada. Now, if you look at those two definitions, the U.S. one and the Canadian one, you could easily have a situation where a trust is resident in both countries. This is certainly common for individuals, and there's a tiebreaker test on the treaty for individuals, but there's no equivalent for trusts. So you can get stuck with a trust that's resident in both countries for tax purposes. Now, I'm just going to point out when it comes to tax residency, and we talk about trusts, I'm going to pull in estates, is that the definition of residency under U.S. tax law for estates is extraordinarily vague. It's really not helpful at all. And one of the common errors that get made is the thought that because someone was a U.S. citizen and they live in the U.S., that means their estate is a U.S. resident as well. If it's being managed by a Canadian person, that estate becomes resident in Canada. And so the residency of estates can move across borders pretty quickly, as it is with trusts as well. Now, I'm going to just add one other concept in terms of residency with respect to Canadian tax law, and that's deemed residency for trusts. And that is where there's a Canadian resident contributor or beneficiary, the trust can end up being a resident of Canada. And again, this ups the ante that you can end up in a situation where there's a Canadian resident contributor, but the trust is supervised by U.S. courts, and a trustee is making all substantial decisions, and now you've got a dual resident trust.
And Warren, we'll talk a bit about that, further on in the presentation, and that may be a good thing to be a resident of trust, a Canadian resident trust. That may be a bad thing. We'll go through that.
Sure. And Steve, I don't want to steal your thunder on that one, so we'll leave that till later. There are a couple of U.S. tax issues I want to draw your attention to. One is transfers to non-U.S. trusts by U.S. persons. That this triggers a U.S. tax liability. Now, it's not a problem if you contribute cash, because there's no gain on cash. But when you contribute, a U.S. person contributes to a trust that's not resident in the U.S. or distributes appreciated property to a trust that's not resident in the U.S., that is going to trigger a U.S. tax liability. Now, think, well, that never happens. Well, just hang on a second. You've got a client living in Canada who happens to be a U.S. citizen, and they're making a contribution to a Canadian trust. They're triggering a U.S. tax liability, even though there wouldn't be one for Canadian purposes. So the potential here is substantial. And understanding who your client is critical. And as you may know, because I know we have a lot of financial advisors and lawyers and accountants on this phone, is sometimes your clients aren't entirely clear on what their status is. That's really important for you to know whether or not they're a U.S. citizen or even a green card holder and what their status is relative to the U.S. I want to raise one other question on U.S. tax issues for trusts, and that is, when is a trust not a trust? We touched on that a little bit before, but U.S. tax law says that when a trust conducts a business activity it will be taxed as a corporation, not as a trust. It's an association taxable as a corporation, as the U.S. words. So if you have a trust that holds real property and it's rented out, typically it'll be treated as a trust. But where you have a trust that's developing real property and in conducting a business, at least in the minds of U.S. tax law, it will be taxed as a corporation. Now, the most common example of this, and I think most Canadian financial advisors are aware of this issue, is with regards to Canadian mutual funds. Most often they're formed as trusts, but for U.S. tax purposes, they're treated as corporations. And because they're treated as corporations, they end up being in that category, being a passive foreign investment company or a PFIC. So you have to think about what is this trust doing and how is it going to be taxed for U.S. tax purposes. So I'm going to push over here to Marsha, and she is going to follow up on some common U.S. trusts and some other tax matters associated with trusts.
Thanks, Warren. Very much appreciate your intro. And when we talk about common U.S. trusts, we're really looking at a whole buffet, really, of different types of trusts. But I think the one common theme that needs to be think about is these trusts are trying to attempt to do either two things or one thing altogether. As you know, U.S. persons are subject to U.S. income taxes, and U.S. persons, when they die, or U.S. domiciliaries, are subject to U.S. estate taxes. And unlike Canada, which doesn't have an estate tax, the U.S. has a very robust estate tax regime, which will basically tax the estate of a U.S. person or U.S. domiciliary to the extent that they exceed a certain exemption amount. Now, for 2021, if a person were to die, and I know Warren's going to talk about this later, there will be an exemption from the estate tax, which is 40% of $11.7 million. And that is, subject to several different, iterations on how you get to $11.7 million. But basically, these trusts that are made during death or made at death or made before death are either attempting to, address an income tax issue, so the person that owns the asset will not be subject to U.S. income taxes on, income generated from that asset, or, the person's estate will not have this asset when they die, so that they won't be subject to U.S. estate taxes. So that's just like it's either an income tax or an estate tax strategy that's being done for these trusts. Now, the revocable living trust is the most common one, I think, that many Canadians have. I don't know about you, Warren and Steve, but usually when a Canadian comes over here and they stay in Arizona, they're kind of our Florida, they're snowbirds, and they do what the U.S. folks do when they have they acquire U.S. property, and they all enter into these revocable living trusts. And these revocable living trusts don't really help you. This is the exception to the strategy, as I said, for the income or estate tax, because the revocable living trust is basically, we see it as a will substitute. So all it really does is it legally transfers your assets to a trust so that it could bypass or avoid probate. And it really doesn't save you in terms of, an income tax or an estate tax, because you still have full control of the property that you've now legally transferred to this revocable living trust. You could do anything with the property. In fact, you don't even need to get an EIN or an identification number for this trust. You just report everything that is in the trust. If it's income, if you sell it, if it's gains, it's all treated as if it's still yours from a U.S. income and estate tax perspective. So it really just avoids probate. And as you know, in certain different states, probates can be expensive, and probate can be a long drawn out administration. So many folks usually like to do revocable living trust. Now, as you'll see later, for cross-border folks, Canadians that come to the U.S. and U.S. individuals that go to Canada with revocable living trust, this can be, this is something that you really need to look into, because it could have impacts in Canada when you go to Canada with a revocable living trust that's set up in the U.S. So the marital or bypass trusts are actually what we call credit shelter trust also. These are used to transfer assets to avoid estate taxes. But, the decedent or the person who died can create the credit shelter trust by including certain provisions in the person's revocable trust and leave the assets at will for the spouse, the marital property for their use, for their income, for their enjoyment, for basically their health, maintenance, and support. And then when that surviving spouse dies, then the rest of those assets move on to the other beneficiaries pursuant to the will or pursuant to the original decedent's trust. So that will never be subject to estate tax for the surviving, for the first to die. But then at the second death, the estate tax exemption of the first person to die would be used up to basically shelter the assets from estate taxes. So basically, it's just a way for which a decedent transfers assets to the spouse gets the income, and then later on, when the spouse dies, it goes to the children. The charitable remainder trust is also another income tax play from my perspective, and also an estate tax play, because basically you transfer an asset to an irrevocable trust to a charity, let's say, so that when you die, that asset will not be subject to estate taxes. But however, what happens is the trustee of that trust will basically sell the asset and then reinvest that to generate some income from the asset. And during your lifetime, you will receive income from that asset, even though you've already transferred the asset for the benefit of a charity. Now, the good part of that is you get an income tax deduction the year that you transfer, generally, the asset. Generation skipping trusts are another type of trust that were very common, whereby a grandfather could set up a trust to distribute income to his immediate children. But then, the principal of the trust would grow and be distributed later to the grandchildren and future generations. So this would basically be the rule is the trust should benefit beneficiaries, and the difference between the grantor and the beneficiary should be about 37.5 years between them, so that you would have a generation skipping trust. So this allowed the trust assets to grow estate tax free, and it appreciates in value. The last one.
So Marsha, just on the generation skipping trust, so my understanding with these is under U.S. law, there's two different levels of transfer taxes, at least two different levels. There's the estate tax or the death tax we think of that would apply to the decedent, but there's also a transfer tax or another levy that could apply if the individual is gifting assets or transferring assets from their children to their grandchildren.
Right. So that is basically the same exemption amount, right? You have the estate tax credit for, 11.7 that's immediately available on death. Right? So you look at that, it's a lifetime exemption amount. The generation skipping tax is also right now 11.7 million. So that would apply, grandfathers would try and, let's say you're a grandfather and you issue assets, or you transfer your assets for the benefit of your grandchildren. You basically skip one of the generations, right, which is basically your child. And so before, that would result in, no estate tax for the transfer to the grandchildren. But now there's a generation skipping trust tax, which would basically tax the transfers to the grandchildren to the extent that there's in excess of 11.7 million. So that's now also subject to a limitation. You can't transfer all of your assets to your grandchildren forever. It's subject to the same 11.7 million exemption. And then last and not least, irrevocable life insurance trust, which I think might be common still in Canada, and also in the U.S. And usually the reason why we have these irrevocable life insurance trusts is because the life insurance proceeds usually are part of the estate of a U.S. person who dies. And therefore, it would be part of, the calculation for whether or not your estate will be subject to U.S. estate tax or not subject to U.S. estate tax. So what happens usually is that there is, you remove the value of the life insurance policy from your estate by creating this irrevocable insurance trust, so that on the death, the life proceeds could be used transferred to the beneficiaries to pay for any estate costs that might arise from the death of the U.S. person, or it could be used to be transferred to the beneficiaries directly. But basically, the whole goal is to take the life insurance policy out of your estate, and there's very specific rules on how this ILIT could be done for U.S. estate tax purposes.
Marsha, on the irrevocable life insurance trust, I mean, one of the issues that happens there, of course, is there's a gift tax issue when typically the parent will pay the premiums, and they can gift up to $15,000 US a year. But if the policy, and oftentimes these policies are kind of front end loaded, so they have really high premiums in the early years, there's going to be a gift tax issue there. So there's a total estate planning subject in with ILITs, but they're an interesting subject for clients.
Yeah, usually this is what we call one of the last resort steps that we do when we find that, you've done every kind of planning available, and in spite of all your planning, the client is probably super, super rich, and you just can't exempt all of their assets, right? There's just going to be an estate tax exposure. And the life insurance trust is a strategy so that on the death of that person, and you already know that there's going to be U.S. estate taxes, you have funding to pay those estate taxes. But you're right, Warren, it's very tricky in terms of setting up of the ILIT and the maintenance of the ILIT. So there are specific rules that have to be, recognized and abided there with to be able to say that this life insurance policy is outside of the estate of the person who died. From a U.S. Turning to the U.S. tax trust concept. So now you've got a kind of a smattering of a flavor of different types of common trust in the U.S. There's some more that are coming out these days, and you'd like to be able to spot and identify those. But basically, the same play is whether you're trying to remove an asset from being included in the income of the U.S. person, or you're trying to remove the asset from the estate so that it won't be subject to estate tax. But the very important concepts really are the grantor and non-grantor trust. This is really an income tax concept. So the grantor trust is basically a trust that's created by a U.S. person in general that would have, where the U.S. person has retained certain types of powers or certain types of beneficial enjoyment of the property. So you can find this actually under Code Section 671 to 679 of the U.S. Tax Code. And the particular points really are the 671 lays out, in general, if a grantor has transferred assets to a trust, but has either, the power to take back the asset, right? So you can transfer it, but then you take it back like a revocable trust. You have the power to control the beneficial enjoyment because you can still, sell the asset, dispose the asset, determine the disposition of the asset while it's in the trust, or you retain certain powers over the trust so that, administrative powers like the power to vote, the power to exchange the assets, and, the power to borrow the asset or borrow against the asset in the trust. There's also the power to, just dictate that the income of that trust would be for the benefit of the grantor for the duration of his life. These are powers that we would make a trust, what we consider a grantor trust. So you actually, the U.S. person has not actually divested themselves of this asset because you're still benefiting from the asset. You still have enjoyment of the asset. You have control of the asset. In that sense, if this is a grantor trust, the U.S. person will be deemed to still own this trust. And as a result, it will be subject to all the income from the trust will be subject to U.S. income taxes, and on the death of the grantor, it would still be generally considered to be part of their estate. So the non-grantor trust would be the different or the opposite of what I just described in terms of the powers and the control that's exercised by the grantor. A non-grantor trust means basically, this grantor has irrevocably transferred this asset, has no dibs about this asset, can't control the asset, doesn't exercise these kinds of powers. And, there's so many different iterations of whether it's a grantor or a non-grantor trust. And then you have these kinds of strategies whereby, the grantor has irrevocably transferred the asset for estate tax purposes, but then for income tax purposes still is, including income coming from that asset into their U.S. taxable income for tax purposes. So This is very important because this is usually what we look at, right? Basically, is it a grantor or a non-grantor trust for U.S. tax purposes? Now, mind you, for Canadians and persons who are not U.S., we could have what we call a switch, right? Basically, if you have a U.S. trust, but then, a foreign person basically has the power to revest the assets in that trust to themselves, or the income from that trust is enjoyed only by the person and their spouse for their lifetime, then we would see that foreign person as a foreign grantor to that trust, and therefore it's a foreign grantor trust from our perspective, because it's actually a foreign person that controls the enjoyment. Now, my special section of all of this, and I know Warren and Steve would like this, is Section 679, because it's the only, I think, part of the U.S. Code that really clearly specifies how do you treat a foreign trust, right? Because we've all been talking about U.S. trust, whether it's grantor or non-grantor, but then 679 addresses specifically layout, how do you treat a foreign trust with a U.S. person? Like, what if a U.S. person transfers the assets to a foreign trust? And Warren and Steve and I were talking about this. The foreign trust is a non-U.S. trust. But from my perspective, it's a foreign trust, and you'll see that in the code and the regulations. And therefore, let's say a U.S. person transfers to a foreign trust, and then you also have a U.S. beneficiary of that trust. Just very simple overview. From a U.S. tax perspective, we would treat that trust as a foreign grantor trust that's taxable to the U.S. person for U.S. income and estate tax purposes. So there's also a trust. Let's say you're going to ask me, what if the foreign person actually created the trust before they became a U.S. person? And then, they became a U.S. person. So what happens to the foreign trust when it was created before he was U.S.? Well, there's also the Section 679A4, which basically provides that if a foreign person created a foreign trust, and within 5 years of creation of that trust, it becomes, that person becomes a U.S. resident for income tax purposes, then that trust is treated as if he created it on the day that he became a resident. So basically, he transferred assets to a foreign trust on the day of his residency and gets captured under the U.S. tax rules that we're talking about. And I think that's very similar also in concept. Well, kind of, that Canada also has the 60-month rule before coming to Canada, and then you create that trust and you go over to Canada. And I know Steve's going to chat more about that. Switching now to, so what happens when you have a grantor trust? What's so bad, right? Well, I already said that you have an income inclusion in the income tax and also inclusion for estate tax purposes of that trust. What if it's a non-grantor trust? So basically, not treated as a grantor for all the previous reasons that we talked about. And you're just, your client is just a U.S. person who's the beneficiary to that trust. Well, this is where we come to simple versus complex trust. What type of trust is that? If it's a simple trust, all of the income is distributed, right, out to the beneficiary annually, or whatever kind of schedule they've placed on that trust. But if it's a complex trust, it means that the trustee has the discretion to retain the income within the trust. And this is when you start to get complicated with respect to how that income is taxed to that U.S. beneficiary. So if you have a foreign trust, for example, that is a complex trust, it doesn't make annual distributions of the income, and it retains that income within the trust. The beneficiary then will be potentially subject to what we call the throwback tax in the U.S. So the U.S. basically suspects that, the income was not being distributed, because if the income is distributed to the beneficiary, then the beneficiary would be generally taxable in the U.S. on that income. So the U.S. is suspecting that, you just kept the income and then distributed to save the beneficiary from U.S. taxes. So we're going to deem it as if the income was distributed anyway to the beneficiary, even though it hasn't been. And this is where we get to doing those calculations, saying, well, whether there's undistributed net income in the trust, and then those accumulated distributions then become taxable to the U.S. beneficiary. So, starting from a very simple concept of grantor versus non-grantor, and then, foreign grantor trust. If it's a foreign non-grantor trust with a U.S. beneficiary, then, you're not out of the tax regime still. You still have to look at whether or not there is undistributable net income in that trust because it's a complex trust and it retains all the income, or there's a discretion to retain the income and not make annual distributions.
Now, Marsha, these are all the U.S. rules associated with this, but when you overlay that maybe it's also a Canadian resident trust, suddenly you end up potentially with the income being allocated to two different people, them each paying, one pays U.S. tax, the other pays Canadian tax, and you have no offsetting credits. So you've really created double taxation in some of these circumstances.
Right, and then it also goes, all gung-ho crazy when it crosses the borders, right? Because as you said, it gets subject to Canadian taxation. And then from a U.S. tax, we also have U.S. taxation. So, this is really a difficult area and a gray area, and it's really good to have, counsel on both sides of the border to be able to, splice out all of the issues dealing with these types of trusts. And lastly, I wanted to raise one more issue. Like when we were, talking about this, there was usually the argument that, the trust is discretionary. The beneficiary wasn't entitled to the income. It was all at the discretion of the trustee. This is really, one of those areas whereby, the trust is discretionary, but we will presume that to have been as if, the income was distributed to the beneficiary. So, you have to look at also the history of the trust and see whether, has this trust been making distributions to the U.S. beneficiary historically? So the facts and circumstances also help establish whether or not there's a potential U.S. tax issue in these types of trusts. But anyway, enough of these key U.S. tax trust concepts. Our goal is just to have you get a flavor of, how to possibly, look at a trust from a legal perspective, from a tax perspective, and what are the key triggers, right, when you've identified the trust as a U.S. trust or a foreign trust or a grantor trust versus non-grantor trust. Now we're going to try and take it one more level, right, by making this specifically applicable to Canadian residents. And, Steve is going to talk about this. So now that we've got a whole overview of U.S. trusts and the taxation, very, very general, Steve's going to bring it home to, Canadian residents, because you're going to say, well, what about me? How does this apply to me, Marsha? It's great you're talking about this stuff, Warren, but let's bring it home, Steve. Let's bring it to Canada. What happens when U.S. trusts have Canadian residents involved?
Well, thank you, Marsha. And I can imagine our audience here is always thinking about as they go through their questions, thinking, yeah, what about me? And I can imagine the kind of questions we're going to get here. There's been some great information so far from both Warren and Marsha. I get this great opportunity now to share a couple of real stories here to show you kind of what the impact is. And in particular, the impact of U.S. trusts, how they relate to residents of Canada. And just to recap a little bit what both Warren and Marsha had said, earlier Warren talked a bit about residency in Canada for U.S. trusts, specifically whether a U.S. trust formed under U.S. law with U.S. assets and originally set up by U.S. beneficiaries, how could that be a resident of Canada as well as being a resident of the U.S.? And in those examples, and in general terms, a bunch of different exceptions and rules that have been, formed over the years through law, through court cases like Antle and Guerin in Canada, through changes in law. But in general terms, a U.S. trust is going to be a resident in Canada if one of two things happen. Either A, its management are in Canada, and so the decisions of the trust are being made in Canada, and that can be either the trustees are resident in Canada or there's influential decisions being made by individuals in Canada on behalf of the trust. So that's one. Or, in general terms, a contributor or grantor to the trust, one that put assets into the trust, is or was a resident of Canada. So if you have one of those two scenarios, it's very likely that that trust could be a resident of Canada for Canadian income tax purposes. So what does that mean? Well, as Marsha had listed, all these different types of U.S. trusts, everything from revocable living trusts to GenerationSkipping Trust, all these trusts that were formed in the U.S. may become a resident of Canada. The income and the gains might be subject to Canadian income tax as well as U.S. tax. As Warren had pointed out earlier, you may get a mismatch tax or of income and gains between countries. So you may have one individual taxed in the U.S. and another individual taxed in Canada, or the trust may be taxed in Canada. And if you can't time those correctly, you may get double taxation. We in Canada have something called a 21-year rule, which in general terms means that when that starts to apply, the trust's lifespan is 21 years. And if by the end of 21 years, you either have to distribute the assets back to the contributors, or you're going to have a distribution to other beneficiaries, potentially subjecting those assets to tax on any realized gains. Even if you can time these things properly between the countries, you may still get a fight over sourcing. And Warren, I'm going to put this one to you because this is your example. In a situation where you've got, for example, publicly traded securities and capital gains, Warren, some things that happen there that could cause us problems.
Yeah, when you have shares of Apple and you've got a U.S. resident trust, U.S. tax law will say the source of that gain is the U.S. But if it's a Canadian resident trust, Canada says the source of that gain is in Canada. The problem with that is neither country will allow a foreign tax credit to offset the tax paid in the other country. So this is where dual resident trusts are really problematic. They're less problematic where it's dividends and interest and royalties and things like that. But when it comes to capital gains, there's all sorts of problems, with one exception, that's real estate typically. But that is a problem.
Absolutely.
Steve, and let's not forget, right, whenever you say double tax, everybody says, oh, but we have the U.S.-Canada Income Tax Convention, right? It should solve everything. It prevents double taxation. And, the dual resident trust and the residency of trust is not really addressed in the Canada-U.S. tax treaty. So I don't think you will find much comfort in the fact that, having worked with the U.S.-Canada tax treaty for many years, I think it's one of the most extensive. It's one of the most updated. How many protocols have we had to date? But, there's still loopholes and there's still gaps. And this is one of those whereby, you probably will need to put it into, competent authority if you want to dispute, the residency of the trust as being dual resident trust, and you want to put it in one border or the other, right? Either in Canada or the U.S. And so you won't get much relief from the U.S.-Canada income tax treaty, sadly.
Absolutely. So we've laid out some problems. We've laid out the concerns we have about residency, the fact that Canadian tax rates are higher. We got a mismatch. We got no help from our tax treaty between the countries. So it sounds like being a resident of Canada would be bad. And in some circumstances it is, and that can be prevented. In some circumstances, we actually want this U.S. trust to become a resident of Canada because there's advantages. So I get two different examples. So we'll go to the next slide here. So in the first example here, and I'll lay this out for you here. This was a situation where a family in the United States had formed a trust under U.S. law. They had U.S. trustees. In this case, it was the individual's grandparents that had put securities into the trust. The individual, born and raised in the U.S., traveled around the U.S., lived abroad, and at some point in their life, he decided he was going to move to Canada. Fortunately for us, he had come to us a couple of months before at the advice of his family and said, look, I'm going to settle in Canada. I've got all these different assets. And oh, by the way, I've got this family trust where I'm a beneficiary. And what's going to happen to me? And so we went through the facts in this. And one of the concerns we had is that, well, if he is an individual, if he's got some influence in this trust, we talked a bit about what his role in the trust was. And he said, well, I'm a trustee, I help make decisions, I give advice. And we talked to him and said, well, one of the things you may want to consider here is to resign as trustee. You can still be beneficiary. We went through to say, what makes a trust a resident of Canada for income tax purposes? And we talked about those two prongs we outlaid, that if the decision-making happens in Canada, that's going to make it a resident of Canada trust. Or if the contributors, the grantors of the trust, were residents of Canada at any point in time. So we went through the facts. He confirmed to us that he had never put any money into the trust. It was always from his grandparents. There were other trustees involved with decision-making. We had the individual go through this, and if I remember correctly, they resigned as trustee before they moved to Canada. So when he came to Canada, he was a resident of Canada, of course. The trust remained a resident of the U.S., but because the decision making was done in the U.S. completely, because it was never a resident contributor, this trust was never going to become a resident of Canada. So what did that mean? Well, it meant that from his perspective, he would still be subject to U.S. tax on gains and income from the assets from the trust, but he would never be subject to any Canadian tax at much higher rates on any of the income and gains. He could still pull money out. He just had to be really careful how he managed the trust. You may hear this term called a granny trust, and it's somewhat common. Marsha, you and I were talking yesterday about...
Everybody loves grandma, people. Everybody loves grandma. The granny trust is a very common, trust that's used as a pre-immigration planning strategy, right? Specifically, you've got in our practice, we encounter a lot of granny trusts coming from Hong Kong, China, outside of the U.S., but basically a lot from Hong Kong and Taiwan, really, whereby grandma wants to take care of, her grandchildren, but grandma is not going with them to Canada, right? So grandma, let's say, parks the assets in a Cayman Islands trust or a BVI trust and benefits the grandchildren who are now Canadian residents. So that's the granny trust that we like to call it.
Absolutely. And so in that situation, yes, we got to still tell Canada Revenue about the trust because there's a resident beneficiary here and they're receiving distributions from the trust. So we got to tell Canada Revenue about it, but there's no income tax, there's no Canadian income tax on the gains and income. Yes, there's still U.S. tax because in this particular situation, the individual is a U.S. citizen. So that was a great situation there where we avoided Canadian residency for that trust. In contrast, we'll go to the next slide here. Sometimes you actually want the trust to become a resident of Canada because it's going to gain some advantages. So we'll go back to one of those examples that Marsha had given us on something called a revocable living trust. And it's a very common thing that U.S. residents will use to avoid probate in the United States. It's something where in this individual's case, it was their uncle. Their uncle had never lived in Canada, born and raised in the United States, had a significant amount of real estate in some high value jurisdictions in the United States. And it had appreciated greatly over 10 or 15 or 20 years since they had put that asset into the trust. So when we looked at this and the uncle was talking to his two nephews, and his two nephews happened to be both residents of Canada. There were no other beneficiaries. The uncle never had children. There were some charity beneficiaries, but the two nephews were beneficiaries of this trust, but they were both Canadian residents. And so we talked to them and said, well, here's one of the issues you're going to have is that from a U.S. perspective, this makes a lot of sense, this revocable living trust, because we're going to avoid probate in your home state. When you pass away, there's what's called a bump in basis or an increase in cost basis, the fair market value for U.S. tax purposes. And so from a U.S. perspective, the fair market value, the cost basis of the real estate is going to be fair market value. So only post-death appreciation of assets would be subject to any U.S. federal or state tax. Well, that was a great result from a U.S. perspective. However, from a Canadian perspective, because this is a trust and the trust had to basically continue to exist at death, we couldn't just have the assets willed directly to the two nephews. The nephews became a beneficiary of a non-Canadian trust, and there isn't any increase in the cost basis to fair market value for those underlying assets. So if we hadn't done anything, when the trust went to sell those assets, we've got resident beneficiaries here, that those millions of dollars of appreciation could have been subject to Canadian income tax. There's a number of solutions we could do here. The solution we chose to do is to say, well, if we actually make this trust a resident of Canada for income tax purposes, from a Canadian perspective, our Canadian law, we actually get an increase in the cost basis to fair market value. So where we didn't get it on death, we're going to get it by making the trust a resident of Canada. So to do that, we had the two nephews, and remember the two nephews were residents of Canada, we had them become trustees. We had them make all the decisions in terms of administering the trust, making the decision to sell the assets, sell the real estate. So by doing that, it was only the post-death appreciation that was potentially subject to any Canadian tax, and it saved the family millions of dollars of Canadian tax. So it's counterintuitive, but in that situation, We wanted the trust to become a resident of Canada. If you go back 2 slides there, just a couple of points, and I won't take up too much time. We see college savings plans all the time. These are similar to registered education savings plans in the U.S. where individuals contribute funds. It's to their children's post-secondary. These are trusts under Canadian tax law, under U.S. tax law. When families move from the U.S. to Canada with College 529 plans, the income gains are subject to Canadian tax. And the challenge there is you've got a contributor. You may not have a trustee. The College 529 plan may still be administered in the United States, but the contributor, if they move to Canada, that act makes it a resident of Canada trust. So, unfortunately, the income, the gains, and everything else is going to be taxable in the year. We like College 529 plans because they're tax-free, generally from a U.S. perspective, but they aren't from a Canadian perspective. You're somewhat limited in the strategies you can choose here. You want to try and minimize the Canadian income tax, and perhaps you can take a different choice on your investment strategy to focus more on unrealized capital gains and capital growth to delay that Canadian tax. We've seen situations where people have 3 or 4 children, they got 3 or 4 different plans, and so that might mean 3 or 4 different filing obligations in Canada, so you got a lot of compliance costs. If you can consolidate those into one plan, you might reduce your amount of compliance costs. The strategies we see people try and do where they give up control to their brother or their cousin, because they were the contributor to the funds, that's not going to avoid that trust being a Canadian resident trust. A lot of information there. And I'm going to turn it now to Marsha, who's going to talk a bit about, I'm going to turn it to Warren, who's going to talk about estate and gift tax.
Yeah, we knew there was a lot of material here, so we're going to try and kind of power through this. I know this is exciting stuff. I'm going to talk just briefly about U.S. estate and gift tax. And for U.S. citizens and U.S. domiciles, they're subject to U.S. estate and gift tax on their worldwide assets, regardless of where they live in the world. So it always applies to them. But for non-U.S. citizens who are domiciled in Canada, they're only subject to U.S. estate tax on U.S. situs property. Now you say, well, what's U.S. situs property? Probably the biggest category that surprises people is U.S. securities. That's principally going to be equity securities, but we'll just talk about U.S. securities. And that's regardless whether it's held through held directly by them or through an RSP or tax-free savings account. They're the owners of that property, and they'd be subject to U.S. estate tax on that property. There are provisions under the treaty which minimize that, but if you have someone with a large estate, they're going to be subject to it. When we talk about large estate, right now, under current U.S. tax law, as Marsha pointed out, that's $11.7 million. U.S. gift tax, other U.S. situs properties, U.S. real property, that's the biggest category typically. But it also includes other personal property in the U.S., whether it's artwork, cars, machinery, all those things would be subject to it where it's located in the U.S. U.S. gift tax only applies to tangible property located in the U.S. I want to highlight one thing here that most people don't think of as tangible property, but it is cash. So when you say to your child who's moved down to North Carolina, is living down the side, I'm going to bring you some money, you can buy a home. I'm going to don't cross the border with over $10,000 in cash. That's not a tax problem. That's a criminal law question. So you don't want to do that. But what you really want that child to do, don't go down to the U.S. and hand them the money or write them a check. Ideally, you want to have them come to Canada and receive those monies, or put in a bank account for them in Canada and have them withdraw it. So gifts of cash can trigger U.S. gift tax, and most people don't appreciate that. Here's where the intersection of trust and estate and gift tax often comes, is using trust. Now, I've had numerous conversations. I've had a couple within the last couple of weeks, actually, this situation where a Canadian advisor has said, I hear trusts are a good way to avoid U.S. estate tax on real property. And that's often true. The problem is this, and as advisors, you know what probably happens. You get a call from one of your clients, say, hey, I'm down here in Phoenix, and I just signed a purchase agreement to buy property. And I heard a trust is a really good solution to hold this. And I said, it's already too late. Once you've identified a property, it's too late. In fact, what I'd really say is if you're going to use a trust, what you want to do is put that, $1 million in a trust, let it sit for a year, and then a year later you go say, let's go find a property for that thing. If you don't do that, what you actually have, potentially at least, is a gift to the beneficiaries. And it's a gift of U.S. real estate. As I just mentioned here, that gift is going to trigger a U.S. gift tax. So the using trusts, you got to be really careful about that. And you can trigger a U.S. Gift tax liability unintentionally there. So that was
I wanted to also point out, right, just to bring home your point, it's a lot of, Canadians who come to the U.S. and stay in the U.S., have advisors here in the U.S. who are well-meaning, right, but they put them in certain types of trusts that won't work for Canadians, and will trigger, types of taxes, as you mentioned, that are not, usually triggered in Canada. So it's always better, what do they say? When in Rome, do what the Romans do. This does not apply to this kind. It doesn't apply to cross-border things. Please do not do what the Romans do or the Americans do with their property in America. It's not really good. Same thing for immigrants in Canada.
This is, whenever you're talking tax on a Canadian in the U.S. and American Canada, you have to think on both sides of the border at all times. So, Marsha, I'm going to pass this over to you and talk about filing requirements.
Yeah, thanks, Warren. So now we've talked all about trust and everything else, and we want to talk about, filing requirements that you'd be subject to in the U.S., right? So basically, what are these filing requirements and why do you need to do them? And I think we're getting to really, for me, Warren and Steve, the most exciting part, well, okay, the other parts were exciting, but now that we've told you all about U.S. trusts and U.S. citizens and U.S. persons that have U.S. trusts or Canadian trusts with U.S. persons in them or Canadians in the U.S. trust, all that thing, what does it really mean? Like, how will the IRS really, where does the IRS come into the picture? Right. Well, the Small Business Job Protection Act of 1996 actually expanded the information reporting requirements for, certain types of trusts that are owned by U.S. persons. And so, the reporting of certain transactions with foreign trusts are required. So, for example, you have a U.S. person who makes transfers to a foreign trust. For example, a Canadian trust. You have U.S. owners of foreign trusts. As we said, if this is a foreign trust, but it's treated as a grantor trust, then the grantor is a U.S. owner. Then you have a U.S. reporting responsibility. If you are a U.S. beneficiary of a foreign trust, and this aspect has been drastically expanded over the last few years, you would also have some reporting requirements with respect to that foreign trust, regardless of whether or not you've had something happen with that trust, you receive the distribution, and the trust receives or has certain types of assets that are reportable for U.S. tax purposes. And then, if you have a U.S. person who receives large gifts or bequests from foreign persons, that would be subject also to U.S. information reporting. And the most common of which, when we were working on most of these foreign trusts and Canadian trusts also, is the Form 3520. And a Form 3520 must be filed by a U.S. person who, is considered the responsible party under the regulations for a reportable event. So what are those reportable events? They created a foreign trust, maybe created a Canadian RESP. Well, we'll talk about that later. They transferred money or property to a foreign trust. And, on the death of that U.S. person, they owned a certain portion of a foreign trust, or it was includable in their estate because, maybe it was a foreign grantor trust. It also is used, Form 3520, when the U.S. person receives directly or indirectly distributions from a foreign trust. And also, you could also use Section 4 of Form 3520 to report, a gift of more than $100,000. I think, this is inflated. So last time I checked, it was $109,000, but the statute says $100,000 from a non-resident alien individual or a foreign estate. So we would consider a trust a foreign estate. but then you have the first of for the 30 other parts of the 3520. So if you have, your grandma from Taiwan who gives you $200,000 and you're a U.S. resident or a U.S. citizen already, then, you have a reporting responsibility that needs to be filed in a 3520. Also, if you receive something from a foreign entity, you're like, Grandma didn't give nothing to me, but wait, she had a foreign corporation, or maybe she had another entity like a partnership, and you got $15,797 from that partnership. So there's specific rules under what types of reporting thresholds, money it is that you receive from these foreign entities. And so the due date for the 3520 is the same as filing an income tax return due date, including the extensions. Now, for U.S. expats, outside of the U.S., you have June 15, but then you also have extensions. So, you need to work closely with your CPA to make sure you don't miss this 3520 being included in your income tax return. Now you say, so what, Marsha? So what if I miss it out? It was just a reporting, an information reporting. It's not really, nothing else. No harm, no foul. Well, actually, there is harm and there is foul because the penalties for failure to file this form is going to be the greater of $10,000 or 35% of the gross amount of the transfer or distribution from that trust, or 5% of the trust assets that are treated as owned by that person that was supposed to report it, the U.S. person. So for a foreign trust that has maybe $2 million, this could be a sizable sum if you apply any of these percentages, right? So 10,000 is, compared to 35% or 5%, these could be, these amounts could become really, really serious concerns. And don't forget, you've got interest on penalties. And, those are going to be really, really bad for you. So generally also for 3520, only gratuitous transfers are reportable. So when it comes to gifts from non-U.S. persons, but then there are also certain types of obligations that what we call qualified obligations that must be reported on a 3520. So what about the Form 3520A? Now, remember, we've talked about foreign grantor trust, right? A foreign trust wherein a U.S. person is treated as the owner of that trust. Then that owner has to file a Form 3520A. And this is really the area that has been most controversial, Warren and Steve, I think, in the last couple of years, because, if you are deemed the U.S. owner of this foreign trust, but you're not actually the trustee, let's say you have a corporate trustee based in Canada or somewhere else, you don't have all of the information, right? Because you don't manage the trust, but you're deemed to be the owner, and you're required to file a Form 3520, which provide very important information about the activities of the trust, the income of the trust, the assets of the trust. And that's not due, this 3520A, the same time as your income tax filing returns are due for U.S. persons. It's actually due ahead of the tax reporting, so March 15 each year. And if you fail to report that, you also have a penalty of $10,000 or 5% of the gross value of the trust assets, treated as owned by that U.S. person. So the penalties could really add up. And also, what happens if you miss, the original filing date for the Form 3520A? Well, before, we would then file, a substitute 3520A along with an income tax filing for that U.S. person. But these days, Warren and Steve, I don't know about you, but, we're getting a lot of automatic 3520 penalties. For every single thing that comes out, or if it's filed late, or if it's filed without enough information. I think this is an area that the IRS has actually identified in their campaigns as one of the areas that are ripe for enforcement, because there's a lot of non-compliance. So many years ago, well, maybe not that long ago, maybe in 2018, when I was in Canada, working in Calgary, dealing with a lot of Canadian trusts and reporting.
Marsha, we've got to wrap up here to get to our question and answer. So
basically, you have we filed what we call a technical paper requesting the IRS to take a look at, particularly Canadian registered education savings plans and registered disability savings plans, and filed saying that these are foreign trusts that should not be subject to foreign trust reporting for so many reasons. And ultimately, Revenue Procedure 2020-17 was issued in March 2020, which basically exempted, if you look at that, certain tax-favored retirement plans and non-retirement saving plans. And the RESPs and the RDSPs fit within the categories and the conditions or the elements of what would constitute an exempt trust from foreign trust reporting. So take a closer look at the revenue procedure, because that is really special for Canada, and we'd love to have you benefit from that. Over to you, Warren.
Outstanding.
Actually, I'll pick it up from here. So, Marsha, I think deserves a lot of credit for what that revenue procedure that was issued. She had written some papers to tax notes. She had been asked to speak to the IRS about this level of compliance. When that came out, there was a lot of relief in the industry that we didn't have to file these forms that weren't adding a lot of value, that were just copying people's lives. We owe a lot of debt to Marsha for her leadership there in trying to get this resolved. So kudos to you, Marsha, for leading that. We're right on 10 o'clock. We really appreciate your time, and I hope this topic has been of a lot of interest to you. We had a lot of fun trying to put this together. This has been a little more complex for us, and so I think this won't be the last one we do on this topic. We're going to try and get to some questions here, and our team's going to kind of put those to us. If you want to keep putting questions in, there's a button right at the bottom there that says Q&A. You can submit questions there. We will be sending out a survey after this. We want to do more of these. We want to get your feedback. Tell us how we did. Tell us what other topics you'd like to see. Tell us how we can improve. We really value that feedback. So I'm going to turn it over to our panel here to go through some of the questions here, and we will do that.
Thanks, Steve. That was great. I learned a lot myself, to be honest. So we do have quite a few questions. First off, I wanted to ask you, Marsha, you mentioned and touched on RESPs and RDSPs and how they're treated as trusts. We did have a question specifically whether or not an RDSP would be taxable by the U.S. Under those rules.
Well, under those rules, the Foreign Trust Reporting Revenue 2020 just exempts it from filing of the 3520A. It doesn't really exempt it from filing of other forms and also income inclusion. So while you're exempt from technically the information reporting for the RDSP, and you can claim Rev Proc 2020-17, you're not exempt from other types of, tax filing obligations and potentially inclusion of that. If it's a grant or trust, then you will be subject to U.S. income taxes for that RDSP account.
Thank you. That's great. Another question is, when we were talking about the generation skipping exemption, now, is that going to be an 11.7 million exemption plus the 11.7 million exemption for estate tax for a total of 23.4 million, or are those exemptions separate?
Those are separate exemptions, right? So you have an 11.7 million for estate taxes. You have an 11.7 million for the generation skipping transfer tax. So in a way, I guess you could see that's 23.4, but it applies very differently, right? The generation skipping tax is only for transfers to 37.5 years. To beneficiaries that are 37.5 years difference between you and between the beneficiary and the grantor. The estate tax is like for anyone you want for your estate directly, and you transfer to directly to, let's say, your child and everything else. So while I'd say those are coextensive in a way. I wouldn't think of adding them up, because if you try to add those up, it really you might fall into trouble if you say, well, I have 11.7 for estate tax, 11.7 for GST, therefore I have 23.4. Technically, yeah, those add up, but they apply very differently. So I'd be very cautious about that.
I think the key on generation skipping tax and the advantage of using this type of planning is that you're pushing that liability beyond the next generation to one that's 2 generations away, and so you're deferring that liability perhaps 50 years or 75 years versus 30 to 40 years. And so that can have a real advantage. Whether that tax liability is going to exist in any kind of form in 70 years, nobody knows. But by kicking it out, that really helps. That voice you're hearing, Darren Basterach, is a senior tax manager in our Calgary office. And Darren, we appreciate all your help here. I'm sure you got some more questions.
Thanks, Steve. Another question here. So if a non-U.S. person dies with U.S. situs assets, is it their entire estate that is subject to estate tax, including life insurance payouts to beneficiaries, or would that just be U.S. situs assets?
Well, that's one of the most common questions. Warren, why don't you take that one?
Sure. U.S. non-U.S. person, in other words, non-U.S. citizens domiciled outside the United States, are only subject to U.S. estate tax on their U.S. situs assets. So that's, U.S. real property, U.S. securities, personal property located in the U.S. But The computation of the tax is based on their worldwide assets. So if someone has $2 million of worldwide assets, and it's all real property located in the U.S., but they happen to live in Canada, they will not be subject to U.S. estate tax. They will be subject to U.S. estate tax, but they'll actually credit out of U.S. estate tax under the Canada-U.S. tax treaty. On the other hand, if they had $100,000 of assets in the U.S., but their estate was $20 million, they would definitely end up with a U.S. estate tax liability because they exceed the current exemption of $11.7 million. But it's only the $100,000 would be subject to U.S. estate tax. Now, the estate tax could end up being about 40% or $40,000, but it's still just the U.S. assets that are taxable. But the computation of that tax is based on their worldwide estate.
Thanks, Warren. And I just wanted to mention that although it's 11.7 million right now that you look at for that threshold, that's probably changing at the end of the year and is likely going down.
It's 12.06, 12,060,000 for 2022. At least that's what's been sent out. So it's increased unless
there's tax reform, I guess, right?
Exactly.
So that would be the inflationary, as Marsha's getting at, but there's a good chance that those that are under that 11.7 million may actually be caught by this rule in the future. So something to watch out for.
Right. This is why in the U.S., if you notice, there's a flurry of tax planning and estate planning that's going on in anticipation of a reduction of the estate tax exemption. So they want to make sure that the transfers are done before that reduction happens. And in any event, the 11.7 million is set to sunset in 2026 to 5.6 million. So it's not going to be, at some point it really is going to be reduced, Aaron. So it's sooner or later, hopefully later. And maybe you'll make enough transfers by this time to avail and maximize the estate tax exemption.
That's a good point. There are transfers available now, some tax planning, maybe do a gift. Yeah, for sure. Great. So another question here, an individual holds a Roth IRA and they're a Canadian resident. Apparently these can be considered trusts for Canadian purposes. They're wondering if they're able to contribute to the plan as a resident of Canada.
Sure, I'm happy to take that one. So a Roth IRA, just to back up, is similar in some respects to a tax-free savings account. It is a plan that's a registered plan. Americans can put money into the plan. The growth in the plan is not taxed. When they retire at a certain time in their life, after a certain age, they can pull money out tax-free. If I remember correctly, there are some individuals in Silicon Valley and others that have put hundreds of millions into these types of plans, if not billions into these plans. And so they're quite popular. From a Canadian perspective, there's partial recognition of these accounts under the Canada-U.S. tax treaty. And it effectively works to recognize their tax-deferred nature. So when a U.S. person comes to Canada with a balance in their Roth IRA, so long as they make an election with their tax return to designate that as such, and as long as they never contribute another dollar to that plan while they're a resident of Canada, that plan can stay tax-deferred for both U.S. and Canadian tax purposes. So to answer that question, the moment that U.S. individual puts another dollar into the Roth IRA after moving to Canada, we've wiped out the ability to defer tax in Canada. And so, yes, you can have them, but they're not very effective going forward. There's other plans, tax-free savings account, for example, and we haven't touched on that, but that has a limited amount of attractiveness for U.S. citizens. That could actually be a good vehicle. But a Roth IRA, you got some limitations.
Thanks,
so
Steve.
Steve, you brought up TFSAs, tax-free savings accounts, and there's a lot of advisors in Canada and a lot of U.S. citizens living in Canada say, oh, I can't have a tax-free saving account, or it's bad for me to have a tax-free saving account. Now, I totally disagree with that idea. The goal for all taxpayers, how can they reduce their overall tax? The secret with a tax-free saving account is it's only tax-free in Canada. It's fully taxable in the U.S. That's not necessarily a bad thing. It just means their investment strategy has to change a little bit. And the focus there has to be, if they're going to invest in a tax-free saving account and they're a U.S. citizen, they also have to invest in a non-registered account in Canada and use the tax they pay in Canada, that non-registered account, to offset the U.S. tax that otherwise apply to the tax-free saving account. So tax-free savings accounts are good vehicles for U.S. citizens resident in Canada. That's another mechanism there they can use to reduce their overall tax, but they have to structure that appropriately.
And then Warren, adding to that, I saw there's also questions about, from an income tax perspective, right, you could have a strategy which basically negates the adverse U.S. tax impact of having a tax-free savings account in the U.S., adverse being you're going to be taxable, with a proper Canadian tax strategy. But from an information reporting perspective, right, it's still up in the air. And I know, Warren, you and I disagree on this, but whether or not, you would still have to file a 3520 or a 3520A for a tax-free savings account. And unfortunately, if you look through Revenue Procedure 2020-17, it doesn't really address it squarely on point, which I wish it would, because I think this is a long-standing, controversy cross-border between U.S. and Canada. We've got Roth IRAs, we've got 401ks, and then we've got tax-free savings accounts. And we need to look at Revenue 2020-17 if you think you're exempt from, foreign trust reporting of the TFSA, and see if it meets the requirements to be exempt. And that's under, I think, Section 5.04 of the Revenue Procedure. There's certain limitations, monetary limitations that must be met to be able to be exempt.
We've definitely taken the perspective that the Mexican land trust ruling applies to tax-free savings accounts, and that it is actually not, even though it's a tax-free savings account, if you look at the documentation, they say it's a trust for Canadian tax purposes. It doesn't constitute a trust for U.S. tax purposes. And the Mexican land trust ruling by the IRS would concur with that. But obviously there's some people taking a different perspective on that subject. And they are an effective tax planning tool. And like everything, you got to look at your personal circumstances for every client.
Absolutely. We're on 10 after 10 here Pacific time. And again, I want to thank everyone here. Darren, I'm sure you got one more good last question to try and stump the panel here. Why don't you ask that?
Sure. I mean, there's enough questions. We could probably talk about this topic all day. But as you guys were talking about the grantor versus non-grantor rules under IRC 671 to 679, are there any instances where someone who's not the grantor may be deemed the owner of the account or may create a grantor trust? And can you talk about how someone who's maybe not an expert in U.S. tax may be able to kind of navigate their way through the code section, specifically 678 and 679?
Oh dear, we're going to need more than a minute to answer that question. But basically, you've hit it on the head. 678 is the section really where which states that if you're not a grantor, you can still be considered the grantor of the trust. If you are if you have the power to vest the corpus or the income of the trust. So basically, that's your pinpoint right there, the 678. And then, you have 679 overlap. It's a bit complex, but, the 679 focuses really on a U.S. grantor and a U.S. beneficiary. It doesn't focus on, whether or not they have the power to vest the corpus or the income, because usually the foreign trust would have a corporate trustee, and the corporate trustee would be the one who would have, the powers to administer the trust and deal with the trust assets. So I think those two go hand in hand. Look at 678. If it's not a 679, then look at 678, because you might have a U.S. person, that is in the U.S. beneficiary, U.S. grantor, but has the power to vest the corpus. So you might get trapped in that. And I'm so sorry, there's no flow chart for that one, but we'll work on that. Maybe Warren and Steve can figure something out.
That sounds great. Warren, do you want to wrap this up here with any final words?
Sure. Well, this is, as I said, this is a significant and complex area. And you always need to be thinking about two countries at the same time, or at least two countries, possibly more. And so it's not good enough to have a U.S. answer. You need a Canadian answer, too. And it's not good enough just to have the Canadian answer. You need the U.S. answer. So we've just touched the edges here. You saw there's even some conflict in terms of some perspectives on it. And that just underscores this area. So thank you very much for joining us here today. We've enjoyed having you participate. And we'll look forward to having you in our next session.
Thank you, Marsha, for joining us.
Thanks, Warren. Thanks, everyone. Thanks, Steve. Bye.